Okay, well, it is a little bit after the hour, so I want to welcome everybody. I hope all of you survive the tax day. That's always a challenge about this time of the year. And I hope you're having a great second quarter. So thank you very much for signing on. I'm Steve Parrish. I'm the co-director of the Center for Retirement Income at the American College. And I know that non-correlated assets is not the sexiest title we've had in some of these webinars, but I really do think today's discussion will help give you some ideas, not on how to beat the market in some way, but tilt it in your direction and maybe limit your losses. That's really what we want to accomplish. So you can read about our guests, Eric and Chris, in our materials, but here's why I asked them to join me today. Eric, first of all, Eric is not really a guest. He is the new co-director with me at the Center for Retirement Income. Eric is replacing Wade Pfau, if such a thing is even possible. And by the way, Wade, so many of you listen to and read, is a professor of practice at the college, like Ed Slott is. So you'll still be hearing from him. So Eric is coming out of the advisory world. So he's an advisor, but he's mixing in academics as he's finishing up his PhD. So he's got the practicalities of serving clients and the academic part. We call it pracademics here. Christian, or Chris Kaplan, is our guest, and he comes from the financial behemoth Equitable, and he's well known in the industry, very well known as a thought leader, and not just in life insurance, but in financial matters in general. So welcome to both of you. So the topic of non-correlated assets in many ways is a study in how to deal with change. You know, if the market never changed, there'd never be a need for non-correlated assets. But in this current environment we got of high inflation and low market yields, change is really the hot issue in retirement planning. Now, I started teaching RICP back in 2017. Now, that was pre-Tax Cuts and Jobs Act and pre-pandemic. And just look at how conditions were then versus now. And the metrics I'm using here are just factors that are typically used in retirement and legacy planning. You can look at it, but basically the point here is back in 2017, when I started teaching RICP, we had higher taxes and higher market returns. Now, current conditions, we have lower taxes, but we also have lower returns currently. And then look at fixed rates. You know, fixed rates in 2017 was the second-class citizen of portfolio design in 2017. I mean, who wanted to put in fixed when they were yielding a little over zero? Well, we now have significantly higher rates, and we have a severely inverted yield curve. So what a different environment for teaching retirement planning, and yet it's all about retirement planning. So where I'm going with this is some of you as advisors would argue, well, this is all transitory. And it's not a cause for concern. I mean, over the breadth of history, there's a pattern, we all know it is, where higher risk assets like stocks are going to do the best. Lower risk assets like government securities are going to do well, but not as high a return. And then they'll all exceed inflation, right? Well, the trouble is that this kind of news is not much comfort to a retiree who's decumulating their portfolio. I mean, the retiree can't eat averages. So just saying on average, they'll do okay. And what you have is a sequence of returns on that decumulating portfolio. Well, the sequence is going to make a huge difference as to whether they're going to benefit or get destroyed by what's happening with those returns. So today, we're going to talk about how to deal with this challenge. How might we get, as Chris Kaplan says, an asymmetrical relationship between risk and return. So by including non-correlated assets, and by the way, locating them in the right tax vehicle, can we avoid and stop the loss that would otherwise occur when inflation is high and markets are low? That's really where we're going to go with that. So let's get the questions going. And Eric, we've had plenty of time to be together, but still on behalf of the American College, I want to welcome you and just throw a question at you to get this thing going. So with your investment background at the client level and working with clients and your PhD pursuits, how would you define the equity market we're talking about with correlated assets? And then would you explain the idea of assets not correlated to the market? Take it away, Eric.
Sure. All right, thanks, Steve. Yeah, so I guess I'll put my my professor hat on here a little bit and discuss kind of what we're talking about here. So big picture, when people are talking about the equity market, we're talking about the stock market. That's kind of, obviously a basic term for you if you're a practitioner and you're on here. But maybe the thing that's not as obvious is this idea of correlation. And so sometimes the word, just breaking it down into its counterparts, is helpful there. So correlation literally means co-relate. And usually what we're talking about is how two things move together. In this case, it's stocks and bonds is typically what we're thinking about when we look back at like the chart that Steve just had up. And it's how those returns of those two move together. So if something's positively correlated, we're talking about how stocks and bonds, let's say, move up together or move down together. If they're negatively correlated, we're talking about how that they move in opposite directions. The reason why that this is such an important thing is that when we're building a portfolio, what we're trying to do is add items to the portfolio that don't correlate to each other with the purposes building a diversified portfolio so that we can reduce risk.
Well, and that makes sense, but it does occur to me that these correlations change over time. You and I were talking, and the example I would give is I always used to, in teaching, talk about the fact that oil and automobile industry are negatively correlated, because when the price of gas goes up, fewer people buy cars. When the price of gas goes down, more people buy cars. But then they invented the electric vehicle, and suddenly things changed. So how can you distinguish between negative correlation and non-correlated itself? And do you think anything is going on with the current market conditions that would change how we'd identify these non-correlated assets?
Yeah, so I hope I don't steal this line from Chris. We were just talking about this before we started recording, and we were talking about this sort of pendulum aspect. So yeah, Steve, if you wouldn't mind putting that one slide up, that might be helpful. So this is just a chart of the return of stocks and bonds. It's their returns over the previous month, and then over the previous 12 months, what their correlation of those has been. So if it's positively correlated, again, that just means that the returns of stocks and bonds are moving together. And if we look at sort of the left side of this chart, what is important about that is that when the returns are positively correlated and both of those asset classes are going up, like we don't care, right? In fact, like we like that. If both of those asset classes are going up and they're positively correlated, that's great. It's when we run into issues like last year, stocks and bonds positively correlated, and unfortunately they're both moving together, but it's both down, right? So that's the concern that we have, as opposed to, like, say in 2008, what was kind of a hidden benefit of the negative correlation between stocks and bonds is that when stocks took a big hit, bonds at least did its part to protect the portfolios. And I think, we were talking about this before we recorded, how you can sort of see here that the correlations aren't fixed and they change over time, right? And I think typically what happens is we have a year like last year where stocks and bonds positively correlated and it's a down year, and we start hearing these or seeing these news lines that mention 60-40 is dead, right? And it's because of that. So I thought this was at least a helpful visual to sort of see that. So, we've been talking about like stocks and bonds, but there's obviously other investment ideas that are beyond that landscape. So I don't know if Chris would be better able to speak to that.
Yeah, let's and
Certainly
hi,
can.
Chris.
Hi there.
I saw you live in Corpus Christi last year. So we've discussed this idea of life insurance. It's so well known as a non-correlated asset. So can you expand on that idea of using that as an asset that doesn't correlate?
Of course. Yeah, I'd be happy to. And this is kind of a personal perspective of mine that I've developed into a white paper a number of years ago to try to define exactly what that, the life insurance asset class can do in a portfolio of other asset classes like stocks and bonds, like Eric was referring to. And I think we got to keep focus on the death benefit here, because I define that as the non-correlated asset class, if you will, not necessarily the cash value. And I define it as very simply in that a death benefit pays out at the event of mortality. And so mortality risk is inherently uncorrelated with market risk, right? So to the extent that you can incorporate, and this applies more, I think, to multi-generational portfolios. Maybe it's not, maybe it's the terminal portion of the retirement planning time horizon, right? So this isn't necessarily something where clients are encouraged to buy life insurance, death benefit protection on themselves to be able to reduce the correlation coefficients of their retirement portfolio as they're spending down their portfolios in retirement. So really, it's inherently mortality risk increases the older you get. So it's kind of a log normal curve or a compounding curve in terms of its statistical probability to occur. I would say it's more akin to event-driven risk, similar to some hedge funds focus on event-driven risk like mergers and acquisition or M&A type activities or bankruptcies, etc. Mortality happens to be uncorrelated fundamentally. And so we get to some interesting points here, particularly as you work on multi-generational planning, to where it stands to reason that this kind of balloon payment or the payout of the death benefit proceeds occurs unrelated to where we sit in the market or the credit cycle. And so when you include that in an overall portfolio, when you look at the totality of a client's portfolio with a multitude of market-based asset classes, and you include cash value life insurance or the death benefit component of that, it actually lowers the overall risk profile or increases differently for the kind of the finance nerds in the room, in the proverbial room. It increases the Sharpe ratio of the portfolio on a risk adjusted return basis by including it. And primarily, or I should say the primary reason why that works is because you set the correlation coefficient now to 0, because it's intuitive that they're uncorrelated with one another. And that has some improvement factors, and it's actually an intriguing concept that I continue to develop, because I think for the right type of customers and for the right type of planning, as I keep emphasizing multi-generationally, it has some interesting ways of supporting the overall portfolio balances when you have major drawdowns, such as last year where both stocks and bonds went down together. You still have that totality of that death benefit available and accessible once that event ultimately ends up occurring.
Yeah. Now, that's great from a finance nerd perspective that you use the term, so I can say that. Let's talk about the tax nerd perspective too. I mean, not only the nature of the asset, but where you locate it. So why don't you talk a little bit about how asset location can help amplify the effect of having those kind of assets?
Sure. So yeah, so the concept of asset location really has to do, to your point, with more tax planning and tax diversification to improve the after-tax returns of our portfolio. Now that can be done, when you factor in the tax component associated with various types of asset class investing. It will either enhance or amplify or reduce the correlation coefficient associated with those two asset classes. So one way you'd like to obviously avoid, what you'd like to avoid is obviously a double drawdown, in the sense that your assets may be volatile, or your investment asset class may be volatile, and you have drawdowns, but then when you sell that asset, to the extent that you have gains in there and you have to pay tax, it further reduces the liquidity, the net cash flows, as I call it, of that asset class when it gets liquidated to be used to spend down in retirement, or during your non-income producing years, as it were. So I think that the two pieces together, they're related, but they're not perfectly related. So they're not perfectly correlated here in terms of the two ideas. But I think some interesting things come into play when you're utilizing cash value life insurance, or should I say permanent life insurance, as a living benefit. When it comes to living benefit planning, you want to modify the portfolio using different types of accounts with different tax characteristics to give the client better after-tax cash flows in retirement. But then, to the extent that you utilize the death benefit component, which hopefully everybody on the call recognizes that the distribution of the death benefit proceeds to the next generation or the beneficiaries is income tax free, you are de facto, by including that asset class, right, the terminal part of your retirement planning time horizon, you are doing de facto tax planning because you are able to actually transfer a stated amount, which is after tax because it's tax free, if structured correctly, to the next generation. So that helps to kind of mitigate some of the issues you have with inheritance of other types of accounts, such as qualified accounts, IRAs, 401ks, but whatever the case may be, where you have some, which I'm sure we'll talk about a little bit later, but you know, the tax efficiency there should be included to the extent that you are doing retirement planning and optimizing withdrawal strategies, and you are keeping in mind the tax ramifications of that withdrawal strategy optimization. To the extent that you have life insurance, permanent life insurance in the portfolio that you're managing for the client, I think it's important to factor in the power of that on an after-tax or tax-efficient basis in terms of transferring it to the next generation.
I'm sold. But let's move away from product of life insurance. And by the way, we've also had in the Q&A already, like cryptocurrency is non-correlated or annuities. So, I mean, there's a lot of them. But let me go back to Eric. Let's talk about alternatives. I mean, alternatives to using non-correlated assets. So how might we use, for example, options as a means of limiting the risk of owning equity? So you own equities, but you limit the risk using that in a volatile or sour market like we have now. In other words, can you limit the risk of holding equities and thereby not have to worry as much about non-correlated assets?
Sure. I mean, I think there's probably two things that come to mind there when we're thinking about ways to manage risk from a portfolio perspective. The first is probably the simplest way is to try to add stop orders. Right. So that would be pretty unwieldy to, oh, someone's saying to speak up a little. Sure. I'll try to speak a little bit more into the microphone here. But yeah, I mean, the other would be if we could try to put stop orders on all of our positions. That would be one way where if the price of that security hits some pre-designated price, that it's just going to sell. There's some, you know, from a portfolio management perspective, that would be ridiculous to try to do for all of our client accounts, and it's probably not realistic. The other way that from an options market perspective that we're thinking about is simply buying a put, right? So similarly, we're just like picking a price that we, you know, want to protect the portfolio at. And if it hits that price, if it goes below that price, rather, on the expiration day, whichever it is that we choose, that it will also allow the investor to sell their position at whatever that set price is. The issue there is that there's no free lunch, right? And so typically speaking, the desire to buy puts, let's say, is when market volatility is at its highest. And so when volatility is high, right, and the market's already going down, that all of a sudden we have this desire and this preference to protect our portfolio. It's also at a time that the cost of doing that is at the highest. So it's just something to be aware of. It seems like we talked about this before, but you know, when you want it most is when it costs the most. And it's really when you realize that there's no free lunch when it comes to the market. So that's at least from an option perspective, how that would kind of work.
And I would say that's a corollary. Sorry, I would say that's a corollary to life insurance as well. You know, the old adage of people always want life insurance after they no longer can either afford it or qualify for it, right? Is as they get older, it becomes more probabilistic that there's a payout on that. And as a result, it gets more expensive the older you get as a result, right? Or medical impairments, etc. So like exactly to your point, Eric, right? There is no free lunch. I think that's the key takeaway is if you plan on hedging using derivatives, right? And it says it right there in the name, they are derivations of the underlying asset class. And very much is driven by how much movement there is in that asset class. And the more movement there is, the higher the likelihood that that option is going to be going in your favor. And as a result, the seller of that option to you is going to demand a higher price because the chance is increasing, you know, within that, you know, time horizon that you have that the option stays in force.
And our audience here is listening to this as I hope you see this is meant to be a planning session. In other words, ideas you can use in planning to help people in retirement planning, because this is not a band-aid for a bad market. We got a bad market. That's just where we are. But that is a related question to you, Chris, is as we both know, particularly in the last decade, suddenly the insurance companies really got into the idea of using derivatives, both with fixed products and variable products. But why don't you give us an overview of some of the strategies that the insurance companies themselves are using in product design to capture some of what Eric talked about as far as limiting risk?
Sure, I'd be happy to. Yeah, it started really prior to me entering the insurance industry. To be frank with you, I kind of think of it as UL came, Universal Life was kind of born in a high interest rate environment, right? Because it's largely driven by fixed income yields, if you will. So that was a very effective way to transfer some of that yield back to the consumer or the policyholder. But as we've been in a de facto up until about last year, we were in a declining interest rate environment. So the insurance industry had to come up with ways to give more potential upside than what was being delivered through pure fixed income investing, which happens on the general account of the insurance company. And so, to me, it was no surprise that, we went from kind of the 80s and 90s, we had an evolution in pension funds starting to shift from more fixed income focused investing to equity investing, because it was kind of the time of the cult of equity, et cetera, because there was so much more upside potential there than what you could achieve in terms of returns on fixed income. So we went from these defined benefit kind of concepts to defined contribution. And lo and behold, in comes the evolution of variable universal life to enable policyholders to access pure equity market returns with its commensurate volatility. Then, and I'm sort of truncating it here to keep the response relatively short, but what you'll notice here on the screen is sort of a representation on an annual basis of what the last 85 years of historical annual returns were. We see that equity markets exhibit an upside bias long term, right? So we want to capture some of that, but we really want to protect clients and ultimately ourselves from those major drawdown years. And so as we reach kind of 2008, I know Indexed Universal Life kind of came to be prior to that, but it was this kind of natural shift is to say, we want some of the equity market upside, or most of it, or as much as possible in an insurance product, but protect us from the downside. And of course, 2008 did a wonderful job of kind of helping the entire industry focus on how can we create, through the use of derivatives and in particular option strategies, generate equity market risk premiums, or capturing some of the equity market upside above the level of fixed income returns, but still protecting the client to the downside. And so IUL came in at arguably at a perfect time, where clients said, I don't want any downside, but I want some of the upside. And so that was the evolution and the invention of IUL. The engine, as it were, is to take a fixed income yield that's generated by the general account portfolio at the insurance company level, and using that to buy what's called a bull call spread on the S&P. All that's saying in kind of options parlance is you want to get any upside from the equity markets, but to get all of the upside within a 1-year time span, or 3-year or 5-year, whatever the duration was, you didn't have enough yield to buy a sufficient amount of options to give the client that full exposure to the upside. So you had to put a cap on it by selling some of the upside at some higher point. And so that was kind of the evolution, where we created the cap and the floor through the use of fixed income yields, buying a combination, buying one option and then selling an out of the money option to give clients room to get some of the market upside in equities in between the cap and the floor. And that essentially created the solution that protected the client from market downside risk while giving them some of the upside. But the natural tendency was, is as interest rates continued to decline, we started to see a decline in those caps, meaning that the client was able to achieve less and less of the upside of the actual equity market. So we see here, if we look on the right-hand side of this chart, you'll notice that the far majority of annualized returns, annualized return years were actually positive, 65 positive years to 20 negative years. And we see a lot of years where the market return exceeded well above, on an annual basis, well above where the average cap levels were in indexed universal life products, right? And they were trailing downwards. So now I'd say the market average is somewhere between 9.5% and 10%, whereas in 2009, 2010, they were closer to maybe 13, 14% upside. So it gave clients an asymmetric bet, if you will, to the upside, and it was quite valuable at that point in time. Now, fast forward to 2019 or so, and those caps are 10, and most of the annual returns in the markets are, when they are positive, they exceed that cap. The clients were receiving less than what they felt they deserved, or however you want to call it, because they weren't capturing the full upside potential of that. But that was inherently the cost associated with protecting them 100% to the downside. So what was the new invention that came into play? Well, it was to say, maybe we don't protect the client 100% to the downside, but we absorb a certain amount of the drawdowns. But the client would be exposed to, some downside risk when the markets are severely drawn down, right? So let's talk in excess of negative 20%, which you'll see is fairly rare, but is that part of the hedging strategy that's so costly. So what am I talking about? Well, buffered or registered index-linked annuities, RILAs as it were, or buffered strategies, where instead of protecting the client 100% to the downside for a moderate cap of 10%, how about we protect the client from the first negative 20% or 10 or 15 or 20%? And that enables us to afford a higher cap, meaning that the client would be exposed to, roughly historically speaking, 5 to 7% of the time, historically, you would have one major drawdown and you would be exposed to maybe 15 or negative 20%, somewhere in the neighborhood when the market's down 40. But in all the positive return years, you can capture 15 to 17% of the upside. Now, so all it's done ultimately is to tweak the risk-return trade-off and the asymmetric bet, as it were, while still providing downside protection, although not 100% because of the cost associated with that. So I feel like we're fine-tuning and we're giving clients more choice and more optionality in terms of how to tweak it. And so, options and choices are good at the end of the day. So I think that's the key takeaway, is all these machinations, they ultimately lead to better optionality for you, the financial advisor, and your clients to tweak it that's appropriate to the client.
And let's make sure everybody understands where we're going with this from a product perspective. And I know we want to keep it short, but so some of these are sitting basically in a indexed universal life fixed, and some are, for example, RILAs or buffered, whatever you want to call it, are in a variable contract. So why don't you just talk about some of the highlights, the good and not so good about those different structures?
Sure, I'd be happy to. Yeah, I think the evolution was indexed universal life. It's a general account product, meaning it relies on the general account yield of the insurance company to support the options budget that ultimately creates that cap and floor at the end of the day. You're basically trading a fixed account yield that was insufficient for your needs to get some equity market upside. Now, as a general account product, and as it pertains to managing a premium allocation to a death benefit focused product, creating volatility control in an IUL is immensely valuable, right? You stand to, over long time horizons, earn something greater than the fixed income or fixed account return or crediting rate that's offered in the contract, right? That's the assumption, that over long time horizons. leading to a discount to the premiums relative to the amount of death benefit you bought. And you want to make sure that you're not exposed to a major drawdown where you could deplete the cash values and ultimately risk lapsing the policy as a result. So IUL came in with this brilliant strategy in my mind. The engine, as I call it, was highly, highly valuable, but it's inherently limited in its how it can be utilized, because a general account product will only have so many investment options to choose from. And I think that's, I like to call it a one-trick pony, right? Like you could have different indices you can be exposed to, but they're generally very positively correlated. So you're limited to kind of sort of one investment strategy there, right? And if 20 years into the future, you'd like to change that and have a different risk return profile, you don't have many things to choose from to modify that in an index universal life or a general account product. You're sort of stuck with it for until, you know, the death benefit pays out. So putting it inside a variable universal life chassis where you can selectively or be tactical about utilizing them at certain parts in the credit cycle or the market cycle now would be a perfect example of where a derivative strategy could be highly useful to clients inside a variable portfolio, because they don't want to take all that volatility risk and that major drawdown in the cash values of a VUL. So the evolution for me, and I'm slightly biased at Equitable, we're very much focused on variable sales, but I think those types of strategies gives, once again, the financial advisor the optionality to say, is it appropriate to put some or all of the client's assets inside the vehicle, the insurance vehicle, in a buffered strategy today to reduce risk? But maybe, so maybe we do that, but maybe 5 years from now, maybe it's a young client, maybe they stand to benefit from more market upside and more pure equity market exposure, to where in a VUL, where you have tons of sub-accounts and you have these buffered strategies as options, to choose from, the financial advisor and the client can be much more tactical about when they decide to use those options and when they do not, right? So again, it allows you more flexibility, and that's generally the evolution here is that it's come into variable annuities, and now they've created indexed annuities and variable annuities with buffered strategies. And we see the same thing on the insurance side, life insurance side, where IUL is a kind of a one-trick pony. It works. It does what it says on the tin for the most part, but limited selection and optionality. VUL with some of those similar type of options gives you choice and optionality to tactically move in and out of those selections when it's optimal for the client to do so.
Yeah, it'd be interesting to see how these chassis evolve over time. But let's just take a shift here in thinking about things. So Eric, when you think about it, I suppose interest rates, and some of the comments in the Q&A here are coming up with this, is that one of the markets in retirement planning is fixed income items, including annuities and that kind of thing. So because 40%, let's say 40% of your retirement portfolio is going to be in fixed assets, is there a way to own assets like that, not correlated to the rise and fall of interest rates? So not just the equity market, but the interest rate market.
Right. Yeah. There's a handful that come to mind. One thing I was just going to mention that when Chris was speaking that popped in my head was thinking about that flexibility perspective. And when we think about, like, you know, I've been an advisor for 15 years. I want sticky assets on my books. I was just thinking about the power of that, like of having that optionality, and from a planning perspective, not just being transactional, you know, and having that ongoing conversation. And so anyways, it popped in my head. I wanted to make sure that I at least mention that.
Yeah.
Excellent.
So
Yeah.
go ahead, Chris.
No, please continue.
Okay. Yeah. So, I mean, from an interest rate perspective, our hands are, you know, maybe a little limited. It's funny because the bond market itself is so much larger than the equity market. But then when we still keep thinking about, like, from a correlation perspective, you know, are we really getting anything for that? I mean, sure, there are a couple that come to mind, tips being probably the obvious one that people are thinking about, where the principal is adjusting based on CPI, so if CPI up, then the principal value of the tips is going up as well. Another one that maybe is not the first to come to mind is convertible securities. I don't know to what extent planners are using these in portfolios, but they're going to be, because they're a hybrid security, right? They have sort of an equity like function and that fixed income like function. There's potential, that they're going to be at least less correlated to interest rates than like what a pure bond is going to do. In the fixed income world, if we're going to own interest rates, I mean, we talk about it. And I know everyone's drawn that picture of like the little teeter totter where you have bond value over here and interest rates over here, and explaining that sort of teeter totter function. We've all drawn that as advisors. But it's really where, like in this type of market environment, where it's really helpful, I think, to discuss why it's important, especially with the way that the curve of interest rates are right now, why we want to focus on that short end when rates are what they are right now, especially, like we talk about that, but then when we experience it, like a year like last year, where if people were owning bonds on the long end of that spectrum, you saw what that did to prices. You felt it, right? You saw it in your portfolio, and it didn't feel good. So yeah, maybe you were eking out a little bit extra return, but the risk that came with that was obviously much greater, as opposed to trying to keep things on the short end. The other thing too that maybe doesn't get discussed a lot, I certainly have clients that have these, is just owning individual bonds and just hoping that they have good enough credit quality, or we're just owning them to maturity, right? And to the extent that the company stays solvent and that the bond pays off at maturity, I mean, that can be helpful, right? Because as long as they have the ability to hold those bonds through whatever price fluctuations they experience, right? I mean, as long as they're holding it to maturity, it's sort of like, so what? So there's probably some financial literacy or like coaching that the advisor has to do to walk people through that time. But so those are a couple of things, I guess, that come to mind from sort of a investment mix that are interest rate. But Chris, I know that from a life insurance perspective, there's some other things that I'm not mentioning, at least.
Yeah, for sure. And as you were talking, I wanted to mention just a point of clarification, right, for the audience. It's something that you touched on, which is perfect, is that if you buy an individual bond and interest rates are going up or down, but you hold that bond to maturity, then that interim interest rate volatility, if you're marking to market your bond, obviously, which most of us don't do on a personal balance sheet basis, right? But if you hold it to maturity, then you eliminate effectively that risk. It just means that that bond may be yielding less than what you otherwise could get if you bought a new bond at some point during the period that you're holding the bond, right? So again, that goes back to your earlier point of there is no free lunch, in the sense that you can make a decision as a holder of, let's say, a 3% yielding bond, and now there is a similar bond with similar credit quality yielding 4%. You could sell yours, but you would have to sell it at a loss, because who's going to want to buy a 3% yielding bond when they can buy a 4% yielding bond? And so that's what actually causes the price or the value of that bond to decline, right? But to your earlier point, you can eliminate the risk, the interest rate risk associated with holding a bond if you hold it to maturity. Now, most of us, when we invest in fixed income securities for retirement planning, we buy mutual funds, or we buy ETFs, or we buy some sort of vehicle that aggregates a number of bonds, and they, due to redemptions and investments in and out of that vehicle that owns that portfolio of fixed income securities, that can increase or decrease based upon buyers and sellers associated with it. So that's where you really get the volatility and the interest rate risk associated. But so again, I'm not suggesting that we all go out and buy individual bonds and hold them for 30 years here, but certainly, if you think about it, that risk, that interest rate risk, can be, to the extent that that bond fulfills a purpose in your portfolio for the duration that it's in the portfolio and you hold it to maturity, it should not have a material impact on the vagaries of the interest rates going up or down throughout that, so long as it accomplishes the goal that was set out in the financial plan that it's meant to deliver, right? So I
And
think
let me
that's
just
important. Yes, go ahead, Steve.
Well, let me throw in one because we have it's come up in a couple different Q&As up here, and I'll just simplify it. As most of you that are listening know, there's cost of insurance that's charged in
Yes.
life insurance contracts, and there's some flexibility to the company and how it's doing it. So there's several statements here about yes, but can't really the insurance company, when interest rates aren't doing what they want to, pick up some of that through the cost of insurance?
Well, yes and no. I would be cautious here because I think when we think about an insurance company, well, when I think of an insurance company, I think of a giant bond fund manager, predominantly a giant bond fund manager behind the scenes. And then instead of raising capital to invest in those bonds or get investor dollars in, we are actuarially well positioned to manage mortality risk. And so we need to charge for that mortality risk because we need to make sure that, some people die before we expect them to, and some people die later than we expect them to. And so we have to manage that sliver to receive the premiums, as it were. So I would associate the pure cost of insurance rates as a cost offset relative to the difference between the amount of money that you've put into the contract yourself, your contributions, and we only charge cost of insurance on the difference between the account value and the death benefit amount. So that represents what's at risk for the insurance company if someone dies prematurely, right? Compared to what was expected through the use of law of large numbers, et cetera. So COIs aren't necessarily investable in that regard because we also have to put certain amount of our investments in reserves, as it were, right? To hedge against the possibility that we have a cascade of deaths that actually occur prematurely before we anticipate it. So we need to make sure that we have risk-based capital ratios associated with that. But I think we kind of use that nomenclature of COIs as kind of a catch-all for all the charges associated with the permanent life insurance contract. But in that regard, certainly, in a general account product, when we receive the premium and we have charges associated with that, and then we have a crediting mechanism, I think this is going back to Eric's earlier point, or as he lobbed it over to me, as how does this relate to manage interest rate risk using life insurance contracts? Well, if you think about it, if the insurance company is buying predominantly fixed income securities, they are exposed to interest rate risk to the extent they are unable to hold the majority of those investments to maturity, as we talked about earlier. So the insurance company is effectively absorbing the interest rate risk in the interim before those bonds mature. But what are we doing? We're translating that into a fixed crediting rate. So setting aside the equity options, the IUL, the RILA type structures for a moment, and just say the insurance company always offers on a permanent product some type of fixed crediting rate on a universal life contract. I think of that as a reflection upon general levels of interest rates, net of a interest spread, just like banks do. But it has no duration risk and no volatility risk, or very, very little volatility risk, because we declare that, okay, if you put money into the fixed account, we're going to credit it 3, 4, maybe in some cases today, even 5% on that money. And if interest rates go up or down, we're beholden to that promise for at least until the next policy anniversary of that policy is typically the way we operate. So to kind of take it all back to our original comment of how do you use kind of certain solutions to manage interest rate risk or volatility, as it were, in your portfolio? Well, you have that ostensibly already built in to an insurance contract. And I would make the argument and extend it even to whole life, is to say the dividend yield is, a good chunk of the dividend yield is a function of what the general crediting rate or yield on the portfolio is for the mutual that's managing that giant bond portfolio. And instead of giving you kind of the ups and downs along the way, they just provide you with a de facto declared fixed amount and says, this is what we're going to provide you. Now, that can vary from year to year, just like the fixed crediting rate can, but generally they don't move anywhere near to the same degree that the interest rates may possibly move, as we've seen over the last 12 to 14 months.
Okay. And
So you have a natural hedge there to interest rate risk, as it were, because we're long-term holders of those investments that may, in the interim, lose value if we had to sell them. But if we don't sell them, we hold them to maturity, and we can still continue to credit the policy with those declared rates.
And I just add one thing to the ideas the two of you came up with is we were talking about retirement planning, and so that gets into longevity. And so let's not forget that maybe one way to deal with interest rate risk is with annuities, in the sense that you have the mortality premium. So even if interest rates tank, the company's on the hook, and that's the way it is. So that it's kind of a hedge against interest rates, in the sense that you don't really know what your bogey is, how long that period of time you're covering. So I would just add that as a asset class that can help at least contain the interest rate risk.
And I think you bring up a good point, Steve, because if you rewind the tape, 20, 25 years, and you look at all the insurance companies that offered guaranteed minimum crediting rates on their fixed accounts, on their ULs, etc., they may have priced in at that time, when interest rates were substantially higher than they have been, to the subsequent 20 years, they may have guaranteed minimum crediting rates they're contractually obligated to honor at 4.5%.
Yeah.
Right? Even though there's no way that new money coming in that's moving into a guaranteed 4.5% crediting rate can actually earn that on a fixed income security that they're purchasing to offset that. So those are loss-making propositions because of the guarantees. But I argue that the insurance company's loss of making that contractual right to the consumer or the policyholder is a benefit to the consumer. And so it should be utilized to the extent that you have access to those, to older insurance policies, to the extent that you have guaranteed minimum crediting rates that frankly exceed what the T-bill rates are today, right?
I
And
think
you have no volatility risk.
The way to end that comment is my brother got a guaranteed lifetime withdrawal benefit on an annuity of 5%. And the company contacts him once a year saying, hey, we'll buy you out. And then he calls me and I say, don't let them buy you out.
Yeah.
That's their problem, not yours. So I want to make sure there's some pretty good questions building up here. So I want to make sure we give some time for that. So Eric, let me kind of throw it to you. And this is one of these more generalized questions that you're coming. But so you're our new co-director of the center and our program director for retirement for RICP designation. What do you think the key topics are in retirement planning that really deal with the issues of this inflationary environment and volatile equity markets? In other words, it's not like it was 7 years ago. What are the areas of concentration in training retirement planning to advisors? You are an advisor and you have this academic background. Where do you think the big issues are before we get to the questions that we have built up here?
Sure. Yeah. I mean, let me just say this. I started as an advisor in September of 2007. And so my first 18 months on the job were during, the great financial crisis.
Mm-hmm.
So what I experienced was that I just heard somebody say this last week, and it was that we don't manage investments, we manage people's investments. And sometimes you don't realize that until all of a sudden the market goes down, right? And it's not that we're just building optimal portfolios. We're helping people that may be inclined to do things when it's not in their best best benefit. So I think it's two things. When we think about if you could build the optimal advisor, what would that look like? And certainly there's the technical aspects. Some of the research that we've done either at the college or seen other people do is that there's a huge opportunity for those that are specializing, especially in retirement planning, whether that's retirement income or things around that. So sort of trying to be unbiased, but the RICP designation is sort of that next step, I think, beyond the CFP. So if you have the CFP, that's fantastic, but I think the RACP, I've just noticed going through the material myself as a student and program director, is that the technical aspects of that have really blown me away. So there's that technical skills, which is why we're doing like this CE today, is to talk about some of these things that are unique, right? That we can go to our clients with and discuss them and really bring value to the table in that aspect. But the other is what I was just mentioning, is the soft skills, right? In that, like, there's sort of that old way that we thought about behavioral finances, like seeing where people made mistakes and then thinking that we could just explain to them, like, hey, you're exhibiting recency bias right now. That's not really a good way to deal with clients. You can't just tell them that they're making a mistake. So
Then what'd you
something that
call
like
me?
Steven, right? So like
Not good bedside manner. Let's put it that way.
yeah, exactly. So there's the whole, which is, sort of obvious, but it's thinking through like how do you actually do these soft skills? How do you learn them? And so like um, Steve and I have been talking about this area of the psychology of retirement planning, right? And bringing in like people's upbringing, their past experiences, how they learn, their psychological risk profile, their money beliefs, financial behaviors, like all of these things, their values or motivations, all of those things come together as to who that person is and how they deal with money. And so we as advisors, I think it's great to have the technical aspects. We need those, like today's CE webinar, but there's also that other aspect of like, how do we actually deal with clients? How do we get them to, like if we make a recommendation, how do we get them to follow through on it? So things like that. So I guess that's the things that I've been thinking about in this role, especially.
And
And I saw something come up quite early in the presentation, Eric, and they asked what is the RSCP? Thank you. Perfect. Retirement Income Certified Professional, for those that are not familiar with the designation. So just want to make sure.
yeah, that's a good
Read my
point.
mind, Steve.
It's 3 courses. And for those of you that are kind of going, well, I've heard about it, but I need help. What we have is a web intensive review program. So in other words, and I typically do these, but we'll not bring in physically, online for a week. It's 4 days, 2 hours a day of really driving down for each one of the 3 courses. So I just wanted to mention that because that's now been built in so that it's actually a part of your tuition. So it was a good opportunity to bring that up. I'd like to move into some questions because we did have some good ones. And this is where you don't know what's going to be thrown at you, but who wants to answer the question about can crypto or some of the other assets be a non-correlated asset? I'm not going to answer it.
I mean, I'm happy to, Eric, unless you have,
Yeah,
if you
go
feel
for
like
it.
it's
Go
top
for
of
it.
mind. I mean, my general stance on crypto would be that a stable coin, to the extent that we can get a digital currency type, conversion capacity, you can create a non-correlated asset class associated with that, but you're not really talking about yield here, right? I think what we've seen over the last couple of years is a massive amount of volatility in Bitcoin, Ethereum, and all the, I'm not going to use the term that everybody else uses, but all the other smaller cryptos, let's just say, in that there's a massive amount of volatility associated with them. And I don't think we've entered kind of the maturation process yet of those stabilizing. I think the concept may be good, but we may be, I'm going to venture to guess, 10 or 15 years away from kind of creating stability. And I think it comes with the lack of regulation, which is inherently an oxymoron when it comes to crypto, because that's its whole purpose, is decentralized finance. But the fundamentals here are very clear, is liquidity drives volatility in all asset classes. So if all the money is getting sucked out of that asset class, it doesn't matter how historically well the correlation coefficient and how well it was suitable in that portfolio, that thing is going down, right? The same applies to crypto, is that there's still a massive amount of movement. So personally, I own some crypto because I generally don't pay attention to things that I don't invest in. So I do it more to kind of keep an eye on it. And I think we're just early enough to where we've seen a massive spike in interest during COVID. And then, now there's a slow but kind of maturation process that's going on as institutions are starting to seriously look at this. So I think we'll get to the next iteration where you'll see volatility compress, and maybe then I could answer that question more in the positive to say, yes, I think that it's a good offset. But right now it seems much more correlated to equity markets and liquidity flows than anything else, frankly. And so it kind of defeats the purpose to reduce the correlation against equity markets, personally. That's my opinion.
Okay. And we had one come in that I thought was an interesting point, because again, we are dealing with retirement. So it's not just a portfolio and trying to deal with what's going on. Long-term care as an element, you could put it on annuity, you could put it on life insurance. But if you think about it, in retirement, what's the real purpose? What's your return is whatever you get for money, and what's your risk is that you run out of money before you run out of oxygen. So with long-term care, that suddenly increases your need for yield. So putting a long-term care rider on a policy of some sort, in a way, is kind of a non-correlated asset, in the sense your bogey may change where you're going to need more income. Someone put that in there, and I thought, well, that's a pretty good point. I think of it as pure risk, but it's also dealing with the fact that you're going to need more money because you have a long-term care event.
Yeah, I think it's an insurance or a protection element. It's a hedge. It's a risk management strategy. I would have to think through a little bit about what the correlation component, and I've been asked this question before when it came up around life insurance as an asset class to, non-correlated, as we almost began with about a half an hour ago. And I think that the idea is more qualitatively powerful than necessarily needing to get into the quantitative analytics of how that, the correlation coefficient associated with that. Because exactly to your point, Steve, we know 100% of people will die at some point. So to the extent that you can fund the policy, that death benefit will pay out, right?
Yeah.
Whereas long-term care is not an absolute, it's not binary. It's in the sense that at some point you will always need long-term care. So that, I think, gets into the point of hedging a risk more similar, I would argue, to the probability of having auto insurance and home insurance. So to me, that looks more like a risk hedge, and it's harder to quantify in terms of its correlation coefficient to other factors, because the statistical probability will go up the older you get, just like the probability of death. But there's at no point is there 100% probability that you will need long-term care. So you're buying protection and a hedge as opposed to something that will definitively pay out and will be to your benefit, I guess, at some point.
Well, I see it's just before the top of the hour, and we always like to be true to these. What we have is a number of questions, and any of you that have listened to these before, what I try to do is respond if I have your email. Otherwise, feel free to send me one. So if your question didn't get addressed, I will do my best. And sometimes I call our guests and ask them the question. But being the top of the hour, I do want to thank Eric and Chris and the audience. Thanks for your interest, because this is not the sexiest topic in the world, but it's a really important one. I really want to first welcome Eric and thank Chris and all of you for attending. We'll try to get back to you on any questions you have, but keep attending, and thanks for your interest, and we hope you have a great day and a great week.